Hello, everyone. Welcome to the Main Street Money Podcast, where Wall Street meets Main Street. I'm Andrew Gay, along with Gilbert Pies and Zachary Green. We are the Texas Hill Country Advisors, independent financial advisors based right here in the Texas Hill Country in beautiful Kerrville, Texas. We'll talk a little bit about the market, but we're going to talk about one of my favorite topics today, which is sequence of returns risk. And I think it's a tricky one. It's fairly complex, but we'll try to boil it down and make it a little more palatable for you guys.
If you hadn't been paying attention to the market the past few days, you have missed out on some interesting happenings, to say the least. You know, even though in our part of the world world was shut down Monday and Tuesday because of the ice storm, the market wasn't shut down. A lot of volatility, I think, more than anything else. We've had 3 down days in the S&P 500. Today was another down day. And we've had some volatility in the commodities markets. We had some big swings up and down in gold and silver. And this week, too, was led by a lot of earnings in the technology sector and some of the Mag 7 stocks. We had Facebook was down substantially today. Microsoft was down substantially yesterday and today. So there's just been a lot of return to volatility. You know, that's one of the things we always talk about, volatility, and we have had it all this week.
So that brings me to my next point, which is a sequence of returns risk. So amongst all the noise that we always talk about going on that's out there, that's just constant in financial market, what are some leading risks that retirees or investors might be taking on that they're not aware of? So simply put, sequence of returns risk is the risk that poor investment or portfolio returns early on in retirement can be disproportionately damaging and affect income stability over the long term, even if long-term average returns remain strong. So in other words, in the first few years after you retire, if you're taking income off of an investment portfolio to support your income and there's poor performance there, sometimes that portfolio can be damaged beyond the point of repair, where it struggles to come back and basically goes into depletion mode a lot faster than it otherwise would.
I remember learning about it when I got licensed. That was the first time I was introduced to it. And it's a lot hairier than the typical risk. You know, diversification takes care of systematic risk, and all that stuff was flowing pretty easy. But this one's kind of a headache. It took me a while to wrap my mind around it. So I'd say it's very important to just truly understand what Andrew's saying when he describes it, because once it clicks, it is something not to freak out about, but something to pay a lot of mind to and speak to someone you trust that's licensed and make sure that they're managing with that in mind.
One of the things that I think is important to point out is that most people, when they talk about investing, they only think about the risk of quote unquote losing their money. Right? That's probably the one thing that sticks out the most to people when you talk to them about investing. But there are many, many other risks you have to be mindful of. And as you pointed out, Zach, it's not anything to freak out about, but it's certainly something to be mindful of, because if you don't know that there's a risk out there you need to be paying attention to, you may not do anything about it until it's too late. And so when it comes to taking risk, most of us intuitively know that we have to take some risk if we want a better than average return. But when you do that, you have to keep in mind, especially when it comes to income planning, the sequence of returns risk, because if you're not careful about it and you make your withdrawal strategy top heavy or too aggressive, if we have a downturn in the market while you're doing these withdrawals, it can really affect the number of years that you'll have available to draw on.
The fact that you as an investor or a retiree might have a traditional IRA, you are forced to take withdrawals out of that type of IRA. So the IRS says that you have to take withdrawals out of that once you reach a certain age. So even if you said, well, maybe I don't need to take the money out of my portfolio, and if we have a market downturn, I can just kind of turn the faucet off and ride out the wave of the market. Well, if it's a traditional IRA, you're going to be forced to take distributions out of that. And there's nothing you can do to mitigate that part of it. There are strategies, there's financial planning strategies, products, and other things that we can use to help mitigate that risk for you. Here at Texas Hill Country Advisors, we work with people who want clarity and confidence around their income picture, especially in retirement. You guys got any parting thoughts that you want to add before we dip out for the weekend?
I think one thing I'll say is next week we have earnings still coming from a lot of the big tech companies. That I think will influence a little bit in the short term what the markets do. But even with all the volatility that we've had, there are still good opportunities for investing out there. So if you're thinking that the market's too high, it's not. If you're thinking it's too low, it's not. When is the right time for you to invest? Today. And if you need some help, come talk to us.
Don't forget, interact with us, share our content, helps other people find the show. We're on Facebook, LinkedIn, and YouTube. Securities and investment advisory services offered through LPL, a registered investment advisor, member FINRA SIPC. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision.